Welcome to Investment Edge Secrets. In this video we'll go over our list of the 15 forever dividend stocks that are the best to buy now and hold. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. The best investment plans are those that prioritize passive income for long-term, tax-paying investors even when the market isn't good for most stocks. Strong long-term returns may be possible with investment portfolios that include reliable dividend stocks. Additionally, a company's ability to reliably pay a dividend and increase payouts year after year suggests that it has a stronger balance sheet and generates higher profits than businesses that don't pay dividends stable. Dividend stocks like ExxonMobil ticker XM, Chevron Corporation ticker CVX, and ABBV Incorporated ticker ABBV are usually among the few securities that investors never get tired of. This is because dividends make up more than 40% of the total return of a company. Morgan Stanley book on dividend investing says that this trend has been clear for more than 90 years up until 2015. These stocks have historically performed better than comparable non-dividend stocks. Dividend-paying stocks outperform non-paying stocks from 1991 to 2015. According to recent data, the average annual return for dividend-paying stocks was 9.7%. While the average annual return for non-dividend paying stocks was 4.18%. Also between 1991 and 2015, stocks that consistently raised their dividends every year did better than the S&P 500 17 of the 23 years. A report on the BlackRock Equity Dividend Fund from April of this year also showed that the dividend stocks in this fund did better than the S&P 500 over the 12 months that ended on April 30, 2022. A Barron's article from May 2022 said that between 1999 and 2019, dividend-paying companies with high payout ratios had an annual return of 10.9%, while companies with low payout ratios had an annual return of 6.6%. Based on their solid dividend stocks and potential for long-term growth, we selected the companies on our list. Let's review our 15 forever dividend stocks to buy now. Number 15, Costco Wholesale Corporation, ticker COST. It has built a strong and loyal customer base, defying the general trend of consumers being fickle over time. The popularity of Kirkland products, as demonstrated by dedicated blogs and social media accounts, is a testament to this. Costco consistently ranks near the top in customer satisfaction surveys. With over $1 billion in membership fees earned in the fiscal first quarter of November 2022, it's clear that Costco has a strong brand built on high-quality discretionary items and low prices for household staples. This retailer is poised for long-term success, even in the face of e-commerce and changing tastes. Number 14, Blackstone Incorporated, ticker VX. It is one of the largest investment firms in the world, functioning in many ways like a private equity fund. In addition to asset management services for clients, where it manages a portfolio of stocks and bonds for high net worth individuals, VX also invests in real estate, credit opportunities, and other hedge fund strategies. With a $100 billion market presence, this firm is involved in virtually every corner of the financial sector. While dividends can be inconsistent due to fluctuations in performance, they are always substantial. The last 4 payouts have yielded almost 4 times the typical S&P 500 stock. Number 13, Johnson & Johnson, ticker J&J. It provides 3 compelling reasons for investment at this time. Firstly, the stock is performing well despite the bear market, indicating investor confidence in J&J. Secondly, J&J supports steady dividend growth and is undergoing a significant change in the coming year. J&J has a history of annual dividend increases for over 50 years, making it a dividend king. This shows the company's commitment to payouts and suggests continued dividend growth. Currently, J&J offers an annual dividend of 4.52 cents, yielding 2.57%, which is higher than the 2.07% average yield in the pharmaceutical industry. J&J will soon spin off its consumer health business into a new entity called Kenvue, a move that will allow J&J to focus on its stronger pharmaceuticals and medtech businesses. In the most recent quarter, revenue in these units climbed 9.2% and 8.1% respectively. J&J is currently trading for less than 20 times forward earnings estimates, making it a reasonable investment considering its dividend growth and expected earnings growth. This is the perfect time to invest in J&J. Number 12, AT&T Incorporated, ticker T. It is a reliable investment with a long history of dividend growth. The company has increased its dividend each year for 36 consecutive years, making it a strong income investment. AT&T recently streamlined its operations by spinning off its stake in Warner Bros. Discovery Incorporated, a move that allowed it to focus on its core telecommunications business and pay down debt. The stock is roughly flat on the year, but it has experienced a surge of 35% from its October lows, indicating investor confidence. As a classic low-risk stock with a generous dividend and a long history of stability, AT&T is a wise investment for the long term. It's a stock that you can buy and hold for the foreseeable future. Number 11, Abbott Laboratories, ABT, ticker, ABBV. It took control of branded biopharmaceutical products. This allowed it to forge its own path, separate from the lower margin medical devices and consumer health products of ABT. Since then, ABBV has more than tripled and outperformed the remaining ABT business. The company has kept its product pipeline full of profitable treatments, such as the popular Freestyle Libre glucose monitor for type 2 diabetes patients, which is expected to bring in $4 billion in sales this year. With a strong outlook and predictions from several industry publications that it will become the largest pharmaceutical company in the next 5 years, thanks to its recession-proof drug sales and unmatched scale, ABBV is a company to watch. Number 10, McDonald's Corporation, ticker, MCD. McDonald's is a consumer discretionary company that operates franchises of its restaurants both domestically and internationally. It's headquartered in Chicago, Illinois. In October 2022, Barclays analyst Jeffrey Bernstein rated the company as overweight and set a target price of $270 per share. McDonald's exceeded expectations in Q3 of 2022 and saw its global comparable sales grow by 9.5%, beating the 5.8% consensus estimate. Additionally, its U.S. comparable sales increased by 6.1%. According to Value Antom analysts, McDonald's can expect a 6.2% annual revenue growth rate over the next 5 years, which is higher than its 3.4% historical growth rate. The company's aim to become 95% franchised in the future will also help it mitigate operating challenges and inflationary pressures. Bridgewater Associates held the largest stake in McDonald's in Q2 2022, owning 2.1 million shares worth approximately $511.4 million. McDonald's, like ExxonMobil, Chevron, and ABBV, is one of the most dependable dividend stocks on the market, with a yield of 2.23% as of November 2022. Number 9, PepsiCo Incorporated, with ticker symbol PEP. It is a global consumer staples company that produces and distributes beverages and snacks. Headquartered in Purchase, New York, the company offers products such as dips, cheese snacks, and soft drinks under brands like Pepsi and Quaker Foods. On October 14, 2022, analyst Lauren Lieberman of Barclays reaffirmed an overweight rating on PepsiCo shares and raised her price target to $185. The company has a strong track record of dividend growth, having increased its dividend for 50 consecutive years, and has a 5-year dividend growth rate of 7.39%. PepsiCo also announced in October 2022 that it was increasing its earnings and revenue forecasts for the year, as well as its organic revenue growth forecast to 12%. Analysts predict an average annualized EPS growth of 7.3% for PepsiCo over the next 3 to 5 years. The company operates in the defensive consumer staples sector, and was the second largest holding in the Consumer Staples Select Sector SPDR ETF. In Q2 2022, 62 hedge funds held PEP in their 13F portfolios, with a total stake value of $4.9 billion, and 60 held it in the previous quarter with a total stake value of $4.6 billion. PepsiCo's dividend yield as of November 2022 was 2.53%. Number 8, Colgate-Palmolive Company, ticker CL. It is a consumer staples company that produces oral care, personal care, and home care products, as well as pet nutrition products. Based in New York City, the company offers a range of products including toothpaste, mouthwash, bar soaps, and more. Steve Powers at Deutsche Bank maintained a buy rating on Colgate-Palmolive shares and set a price target of $85 on October 17. Colgate-Palmolive is a reliable dividend stock, having raised its yield for 59 consecutive years. In October 2022, the company increased its organic sales growth guidance from 5% to 7%. Third Point investors acquired a significant position in Colgate-Palmolive, citing the company's defense and significant pricing power in inflationary conditions. The company's Hill's pet nutrition business has also been a key contributor to its growth, with organic sales growing 11 to 12% over the past few years. As of November 2022, Colgate-Palmolive had a dividend yield of 2.55%. Number 7, The Home Depot Incorporated, ticker HD. It is a consumer discretionary company that provides home improvement products. It sells building materials, lawn and garden products, and other products through its retail stores in the U.S. and is based in Atlanta, Georgia. As of October 31st, analyst Stephen Zacconi at Citi holds a buy rating on HD shares with a price target of $340. The company has a strong track record of raising its dividend, having increased it for 12 consecutive years, making it an attractive option for income-seeking investors. The management team has also performed well, driving profits and revenues. During H1 2022, Home Depot reported $82.7 billion in revenue, a 5.2% increase from 2021, with a 4.1% rise in comparable sales. In Q2 2022, 75 hedge funds held long positions in Home Depot, and 68 in Q1 2022, with a combined stake value of $5.6 billion and $6.1 billion respectively. As of November 2022, HD's dividend yield was 2.57%. Number 6, Merck & Company Incorporated, MRK. It is a global healthcare and pharmaceutical firm that offers human and animal health products. Based in Kenilworth, New Jersey, the company has consistently raised its dividend for the past 11 years. In October 2022, Terence Flynn at Morgan Stanley maintained an equal weight rating on MRK and increased the price target from $91 to $100. Merck's revenue was estimated to be between $58.5 billion to $59 billion in 2022, with earnings of $7.20 per share. As of November 2022, the company had a dividend yield of 2.73%. Number 5, The Coca-Cola Company, ticker KO. It is a consumer staples company based in Atlanta, Georgia. It offers non-alcoholic beverages worldwide. In October 2022, Peter Graham at UBS reaffirmed his buy rating on the company's shares and increased his price target from $63 to $68. Coca-Cola is one of the leading dividend payers, consistently raising its yield for 60 years. The company's Q3 revenue growth was 11% with a 4% increase in concentrate sales. As a defensive stock in the consumer staples sector, Coca-Cola is considered a safe investment during inflationary times. In the second quarter of 2022, 64 out of 895 tracked hedge funds had a stake in Coca-Cola with a total value of $29.2 billion. The company's dividend yield as of November 2022 was 2.94%. Number 4, Chevron Corporation, ticker CVX. It is a global energy company headquartered in San Ramon, California. Charles Rajaya, an analyst at Cowen, holds an outperform rating on Chevron Corporation shares, with a price target of $185, up from $160, as of October 31st. Chevron Corporation has a history of consistent dividend increases over the past 34 years, with a 5-year dividend growth rate of 5.33%. The company has outperformed the S&P 500 with a 121.5% share increase so far in 2022, compared to the S&P 500's 19.2% gain. In Q2 2022, 53 hedge funds were long on Chevron Corporation, with a total stake value of $27.9 billion. The previous quarter saw the same number of hedge funds with a total stake value of $6.5 billion. As of November 2022, Chevron's dividend yield was 3.14%. Number 3, ExxonMobil Corporation, with the ticker XOM. It is a major energy company based in Irving, Texas. The company is involved in the exploration and production of crude oil and natural gas both domestically and internationally. As of October 2022, analyst Neil Dingman holds a hold rating on ExxonMobil shares and has raised his price target from $111 to $114. The company attracted investor attention after posting its third quarter results with sales of $112 billion and operating profits of $25 billion. Exxon is perceived as a growth and safety investment due to its strong yield and positive performance, which provides a hedge against geopolitical turmoil and energy crises. As a dividend aristocrat, Exxon has consistently increased its dividend for 25 years and has a dividend yield of 3.18% as of November 2022. Number 2, rewritten, Pfizer Incorporated, ticker PFE. It is a global healthcare and pharmaceutical company based in New York City. Analyst David Risinger of SVB Securities has a market perform rating on the stock with a price target of 48. With 12 years of consecutive dividend raises, Pfizer is a reliable choice in the healthcare sector. The company raised its 2022 earnings guidance to $34 billion and revised its revenue and adjusted EPS guidance to $99.5 to $102 billion, exceeding consensus estimates. In the second quarter of 2022, 79 hedge funds and in the previous quarter, 83 hedge funds held Pfizer among their 13F holdings, with total stake values of $4.1 billion and $5.1 billion respectively. As of November 2022, Pfizer's dividend yield was 3.44%. Number 1, Devon Energy Corporation, ticker DVN. A buy rating was reiterated by Citigroup analyst Scott Gruber in October 2022. He also raised his price target on the stock from $77 to $80. Devon Energy Corporation is poised to benefit from rising energy prices and increased production of natural gas and oil in the U.S. The company increased its dividend by 22% to a record high of 1.55 cents per share in Q2, and has raised its dividend for the past 4 years. According to hedge fund data, 66 hedge funds held long positions in Devon Energy Corporation in Q2, with a total stake value of $1.9 billion. Devon Energy's dividend yield as of November 2022 was 6.02%. These companies are safe bets that are set up to do well in the hard economic times that are coming in 2023 and beyond. Analysts think that now is the best time to buy a lot of these stocks. This concludes our list of the 15 forever dividend stocks to buy and hold. Before putting your hard-earned money into buying stocks or investing in the market, you should always do your research. Which of these forever stocks would you consider adding to your investment portfolio? Let us know in the comments below. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy on cutting-edge investment strategies for building wealth. Thanks for watching and best of luck with your investments.